So we kicked off today going back to Employment Hero and what's happening there with the Host Plus submission, because the government has actually come out with their own position. So that was interesting.
Yeah, and then that led into a conversation around the flow of funds from super funds into the space and how some emerging VCs are a bit fearful of the influence of those super funds and the big checks that they're writing.
Yeah, and then we segued across to talk about an Australian workforce management software, Deputy, which is the first unicorn in 2 years.
Great to see. We then did a roundup of a whole lot of capital raises, but holy moly, there's a lot of money flowing out. So I think we must have spoken about 10 or 12 different companies from a range of articles.
And then we segued into a post that discuss whether or not the best deals are the ones that have the least fanfare and take the least amount of time.
Which then took us into Jensen, CEO of NVIDIA, was interviewed and he said, I hope you suffer. Now, he wasn't that aggressive. We unpacked suffering and expectation and ambition and our views on that.
I love that piece. And then it led into the need for resilience at Stone & Chalk at the moment, given that they just announced a $7 million loss. And then the news that came out yesterday that Elaine Stead has taken a role with Main Sequence Ventures, which is awesome news. And congratulations to Elaine, but also congratulations to Main Sequence Ventures.
Richard White from WiseTech, and an article out talking about how 85% of WiseTech employees own shares, totaling 320 million. And we talk about equity as a tool, especially in the face of some data that's come out from Carter, where startup head growth has actually started to go negative for the first time in many years, and it's going negative at an accelerating rate. And so using equity, we think, is going to become more important in retaining and attracting talent.
And then that led into Don's public markets updates with charts and some insights which do not qualify as financial advice.
I don't even think they qualify as helpful. Let's get into it.
Let's go.
You there, Jack?
Yeah, I can hear you.
Okay, you're there.
All right, sorry, that took me 20 goes trying to get in.
How are we this morning?
Awesome.
Yeah, going good, Don. Are we live now?
Well, unless there's something that you want to tell us that's not live.
Nah, open book.
You look well rested after a long weekend in Melbourne.
Yeah, had a really good weekend in Melbourne with Anna. Got super lucky with the weather. Couldn't have asked for better weather, so it was a good time. Went to Sunday. Yeah, perched up at a local Irish pub on Sunday. Had a few pints of Guinness. Got chatting to two couples, older couples from Brisbane based, and they were drinking pots. And they were obviously finishing their drinks way faster than me, but they just kept buying me pints of Guinness every time they would get a pot. I wasn't intending to put away a fair few Guinnesses, but by the end of it, like, Anna's like, we got to get out of here. You're blind. I was just chatting away to these people. They're drinking pots. I'm drinking pints. It was a good, anyway, it was a good Sunday.
Did anyone walk away with a tattoo, Jack?
No tattoos. But you got, every time you had 2 pints, you got a bucket hat. So I've got a few Guinness bucket hats now.
Jack. For the listeners at home, we won't go fully into it, but there's someone cruising around that actually has Jack's face tattooed on their arm. That's the level of influence and persuasion this young man has.
That's worthy of a whole episode to itself, that story.
Yeah. Let's not ruin it. We'll keep that. But literally, I should post a photo of that in the show notes. And Aaron, you had the white linen shirt on, no doubt, for your family photos. Was it that level of kitsch?
Look, it ended up a blue linen shirt, but yes, it was that level of kitsch. Yeah, the family photo session, which Murren had won for us, it went really well. But this was an awesome sales strategy on the photographer's behalf, like giving away this free package for a family photo shoot to then upsell us into to being the wedding photographer. Like, well played. And I knew we were being played, but I still appreciated it. So
the photos only come once you've signed the contract and paid the deposit for the wedding.
It's not far off. That's what it feels like.
Everyone wants to buy. Nobody likes to be sold to. But by the time you've entered a sales process and you're feeling like you're getting some value, it's probably not so bad. It's a good lesson for all the early stage companies out there.
So true. So true. What about your weekend, Don? You had Maggie in hospital. You had everything happening.
Yeah. Poor Maggie, the 7-month-old, ended up in hospital for pretty well close to 5 days in the end, which it's hard to be happy as a parent when you're in there. But I tell you what, if you want some perspective in life that everything's probably not that bad, go and visit a bloody children's hospital ward.
Yeah.
But anyway, got her home. So a couple of shout outs from us. We've got a new format that's going to launch next week, where we're going to start doing some deep dives into specific domain topics, where the whole episode will be around the topic. And the first one we're going to do is around creating sales and marketing engines, sales and marketing machines, because across our portfolio and a lot of the companies that we're talking to, the world has just changed in terms of lead generation, sales process, all these things. So we're going to hopefully share some value there of what we've picked up.
Yeah, but we need a name for it.
I think we should ask the listeners. That will prove if anyone actually does listen to the podcast.
I don't like setting those tasks, because then if no one was to contact us, I'd be in an existential crisis.
What was the tugboat that got the crowdsourced name? And it was
Bodie McCoatface.
Yeah, this could be the name.
All right, so yeah, a new podcast type is going to be Deep Dive McDeep Dive Face, is it?
That's the default if no one replies and tells us a better name.
And then we've got the investor event coming up in April with Mick Dempsey, who sold Easy Debit for $305 million and then set up a family office and has then been investing very successfully into early stage businesses. It was going to be at his farm, but a bit like when you're sitting in the airport and someone calls your name for a upgrade, we've been upgraded to his place right on Mermaid Beach.
This is going to be sensational. His place is magnificent. And the fireplace with the Barbie and the little amphitheatre, essentially.
It's good because it'll be like, if you do the right thing and be successful, this is what happened. Mick. Yeah. Then we've got the events at Don's place. If you fuck up. So I think having that balance is nice.
Yeah.
And what date is that? Remind me.
22nd of April. So it is invite only. Details are up on the side. But if you're a investor family office type and would like to come along, just drop us a line.
Yep. And then we've got the offsite in May. A great Friday, Saturday and Sunday together, going really deep into some of the challenges around scaling companies, but also some of the personal aspects around mindset, behaviors, those kinds of things that you need to be able to grow your business, but you need to be able to grow yourself at the same pace. So this offsite is combining those two streams of work. Yeah,
it's capped at about 20. It's open to founders and investors. And it is, for those that have been to a previous Tribe offsite, this one's a little bit different because we are combining the two different focus areas, formats, into one and making it a full 3 days rather than kicking off later on the Friday. We kick off in the Friday morning.
And Jack, have you booked your flights yet?
No, I haven't, but this afternoon, boys.
Get on it, Jack.
So we like to go back and recap on items from last episode. The big one is still employment hero, is an item that keeps going back and forth. And actually, the government has come out saying that it has renewed its calls on companies not to undermine stapling of employees to a single super fund when onboarding new staff. This was an article from Capital Brief from Anthony Galloway. Financial Services Minister Stephen Jones has vowed to crack down on companies seeking to circumvent laws designed to staple workers to a single superannuation fund during employee onboarding programs. Did you get a chance to see that? That's the fact that it's got to this level means that this is a fairly big issue.
Yeah, I think so. There's some changes ahead and we've seen a number of these kind of employment platforms pitch, and there was one specifically focused around making the super transition easier. And some of them have a straight SaaS model where there's other value, but those that are relying on fees or commissions from the super funds, I think will struggle. It looks like this landscape's about to change pretty quick.
One that we saw was an embedded superannuation product, and it was really introducing smart workflows just so you're not doubling up the information. But from a user's perspective, it makes it so easy to switch in between. And when they talk about stapling, stapling won't exist in the world of embedded super just because you can turn off and turn on in between different superannuation funds within 2 clicks. But I don't know enough about the risk on the superannuation fund side. Like, they're placing bets and investments. I just don't know enough of the risk for the superannuation funds and how they manage their investments.
So I spoke to somebody inside Employment Hero yesterday, just having a little bit of a chat. Interestingly, they're not against stapling, and in fact, their functionality for people where stapling is clear in the onboarding process, they've come via a certain path that a fund is there. What was described to me is that fund is then at the top of the list. there are situations where new employees or where you haven't had a fund come in and there are some decisions to be made, that's where this advertising really comes into it. They were actually not concerned about that really because they've got other parts of the business. I think people that are bringing things to market purely to undermine the stapling process. I agree with what you're saying, Jack, long term, but this government at the moment doesn't want to see that happen. Like the majority of people don't actually look at their super, especially when they're young. The competition's at the margins. It's the people that are interested in changing, and some of the super funds that have young, long-term holders, they probably don't want a lot of churn. But the government also doesn't want people with lots of different superannuation funds and the administrative shitfight that creates. And so we discussed that with technology, that issue is going to disappear as well. Whatever happens from an ecosystem point of view, it is important to have super fund money, especially in the scale-up phase inside early stage businesses. So we need to keep that on. But at the same time, early stage businesses is about disruption and doing things better for the end customer. And there's got to be a balance between what's in the interest of all parties and what's in the best interest of the customer too.
Yeah, no, I think like we touched on last week, the thing I've been thinking more about is the super funds being investors in some of these big top tier funds that are then investing in things that may be disruptive to those very super funds. It causes that real conflict. And I wonder if maybe the VCs need to actually forwardly manage that conflict.
In this instance, though, Hostplus ended up with its Airtree investment through a merger with another super fund. Hostplus never did it direct, is what this person told me. And so they indirectly end up with this asset that they didn't proactively make a decision get into. And what I was told there is that Hostplus make up less than 2% of Airtree's book in that fund. Again, I'm only going by third-party stuff, haven't validated that. The main thing is, how do we have an ecosystem where, if there's no self-interest, there's no interest generally, so you've got to have some levels of that. But how do we just make sure that we've got a healthy ecosystem where people are able to engage, innovation's able to flourish, money's able to flow, but it's a healthy part of capitalism that one side comes from one direction, another side seeks to defend it, and the customer ultimately is going to choose.
That leads in nicely to the article in Capital Brief, talking about how the title was actually around emerging VCs fear the big super stranglehold, which of itself I think is something we can unpack and talk about.
Yeah, so another great article by Bronwen Clune. Some people interviewed use the word fear. I don't think from our side we don't fear it. We just see that we have to earn our stripes. We engaged with some super funds early on in our journey, probably a bit naively, not realizing just what you have to have in place. But then we learnt that, we got some feedback, realized that actually, no, it doesn't match this phase of the life cycle. We've put that to one side. We're concentrating on our game here. And ultimately, if we do things correct in the years to come, we'll build a platform that has all of the different ingredients that a super fund wants to see.
Firms like One Ventures that haven't actually taken any institutional funds, and it's not the mandated path. I don't know, the VC community fixates on it, almost like it's a...
It'd be nice to get $100 million check in a single lick.
Yeah, the appeal is nice of the check size.
But it's obviously hard. One Ventures don't have it. EVP, and we'll talk about them with Deputy, they've got another unicorn in their portfolio. They don't have it. It's not something you're born with a right to. Now, would it help the ecosystem to have more funds coming into emerging managers? Yes. Does the data on emerging managers demonstrate that the return is often greater than what these big gorilla funds end up being able to generate? We discussed in the last episode, Warren Buffett said multiple times, size kills returns. And we're seeing that these large VC funds are going from a boutique high margin business to a low margin generic business. And therefore it leaves open space for smaller firms like us to find. For them, the amount of effort to deploy $1 million check and $10 million check is about the same. But if you've got $1 billion under management, you can't be fucking around with $1 million checks, which means you miss out on that stage. Where I think the ecosystem will go is that a super fund will have its big gorillas that can give them the absolute return dollars. I'll put in 50 million, but if they have their 10 and 15 and $20 million allocated to the right emerging managers, that's where 20 million can become 100 million.
I agree. There's a lot of this commentary coming out of the US VCs too. This isn't just specific to Australia, where that top end of the scale, the largest scale VC funds becoming much more institutional in how they operate. And then at the other end, this opportunity for the boutique niche VC funds that are differentiated to perform well. But I think where it's heading, I think if you're in the middle of that market, I think you'll struggle. And again, you never want to be in the middle of any market. And part of our thesis and with us is never aiming to be a large funds under management top end of town. That focus on staying niche and staying in our expertise and staying differentiated is where we think the future value will continue to lie.
Yeah, and super funds are very fee sensitive overall. And so the way they often work with the ones that do have emerging manager programs, it's, I'll give you this 25 million that you can charge a fee on that they'll still negotiate down. It's not the normal 2 and 20, but there's a sidecar amount of say 40 or 50 million that you have to put to work at no fee. So the aggregated fee on that entire amount can then get closer to what they get in generic ETFs and wherever else they stick their funds. And so fees then put some pressure as well.
Yeah, and I think Jesse Wu's comment about there is a gap in the market and there's an opportunity for someone to set up a fund of funds approach, like to take big checks from multiple super funds and then to deploy that and manage that into smaller emerging fund managers. And we saw that going back to the success of the Israel ecosystem, part of that's attributed to Yozma, which was a similar fund of funds approach to establish new fund managers in Israel in partnership with Silicon Valley fund managers. And that worked out phenomenally well. So I think Jesse was right. A fund of funds would be a great approach and may solve some of this. But yeah, we don't fear it. It was interesting reading that kind of sentiment in the article. I guess our focused approach is how we'll continue.
What I've learned through our engagements with the VCDF in Queensland and then just the interaction with the super, the word emerging, we also had a different definition of emerging early last year. And the reality, again, naivety, emerging actually means have emerged, have everything in place, but don't have big funds under management. It's not emerging as in we're going to give you a crack at this. It's you have emerged, you just don't have big licks of capital yet.
I'd even challenge that second part of that. I think there were some that did have big licks of capital that were still deemed eligible.
Yeah. We'll let that one go through the keeper, given the great state that we sit in currently and the ecosystem we have to play. Jack, you could make comments sitting down in Adelaide if you want. See, he's the professional one here, right? Keep his mouth shut. He's sitting there going, just move on, you dickheads. Now, someone who's not truly emerged, Deputy, is effectively the first official unicorn in Australia in the last 2 years. Australian workforce management software Deputy has cracked the $1 billion valuation with its first external investment in 6 years, making it the first private technology unicorn company to emerge since the market soured in 2022. This is an article by Tess Bennett from the AFR. So well done to Deputy. And it's like I mentioned before, it's an EVP company, but a lot of companies I consulted to and a lot of companies we're invested in use Deputy.
Yeah, well done. I was watching a market update on VC and PE yesterday, and the other stats at the moment, not just the lack of unicorn creation or generation, but there's been no tech IPO in Australia and New Zealand in over a year. And M&A activity in the tech space is down 45% from 21. So in the climate of all things, it just highlights Deputy's done incredibly well.
We don't have it on the run sheet for today, but more and more articles are just coming out bashing the shit out of the ASX. Another CEO of an ASX tech company just bemoaned how shit it is being a tech company on the ASX. And then when Canva says, no chance we're going to the ASX, and Airwallex say, no chance we're going to the ASX, maybe we should send a mirror to the ASX for Easter or something, because there's some pattern here. Having been a listed MD on the ASX, I know the feeling.
Yeah.
Now, another batch of companies that are hoping to become the next unicorn. I don't know whether people have just been sitting on their announcements, but holy shit, there has just been a big chunk of announcements in capital raising. Eloise Keating of SmartCompany put out an article that has 7 Yeah, 7 companies raising. And so Eloise's article, the startups that raise 11.8 million, Nullify, 5.2 million. Let's say cybersecurity, AI startup. So that'll be an interesting one for us to watch because cybersecurity just continues to be a big challenge. The next one is FLK It Over.
Flick it over. So Jack and I took a look at this one. It's like a competitor to DocuSign, but it was specifically for real estate agents and another sector. I can't remember the other sector.
How many times do I need to demonstrate my boomerness by not being able to work out it was flick it over and say FLK it over? I'm embarrassed.
I know the prize you're getting at the Christmas party this year.
I am so embarrassed. So to founder Andrew, I apologise. Fremantle Seaweed, 1.26 million. So more than 1,000 investors have backed Fremantle Seaweed via Birchal. We spent a bit of time with the Birchal team down at South Start, and great to see another raise there. 1,000 investors. Matt and the Birchal team obviously have some really great stuff, pulling together 1,000 different people and managing it and keeping it on the rails to raise 1.6 million. That's got to be some good tech.
Yeah, well done, Matt. And it was great to see you at South Start.
Yeah, absolutely. Bay Juice, that's the Korean juice that's very good with its marketing, you were saying?
I was just saying, is that just really good SEO of a great name?
It's funded by Perth billionaire and technology gaming entrepreneur Lawrence Escalante. I tell you what, check out his Instagram. He's enjoying the fruits of his labour. Baza, 650,000. That's a retail startup in pre-seed funding.
I think it'll be pronounced bizarre. like a
Oh, Boomer's on again. I give up. Oh, okay, Jack, do you want to take over reading this?
No, I'm just bad on.
Vanable, Aaron, is there a different way that you would like? No, that's Vanable. So Vanable raised $148,000. Also on Birchal, so great. And Dooley, that's secured $500,000 as well. And it's looking to shake up the billboard advertising space. I'm just doing a search. I have a feeling I'm invested in Dooley.
We saw it. It came up somewhere. I remember it hit my inbox someone. Yeah.
I'm invested in Dooley.
Oh, there you go.
It may sound arrogant what I've just said, just to give some context as to how I would not know the portfolio. Brisbane Angels have a really great thing called Angelmatic. And what Angelmatic is you sign an agreement, and anytime the group invests more than a certain amount with more than a certain number of investors, and there's a whole lot of different criteria, you will just get automatically invested. And for somebody like me who can't go to the meetings at night because of family commitments and whatever else, often the problem is you miss out on good deals if you don't go. Whereas this program means I get auto-enrolled, not a huge amount, but I've then got a ticket to the ball game, and then the ones that become the winners are future co's. So that's a very helpful tool. But one of the big ones that came out this week was Invoice payments startup Marmalade raised 16 million.
Their growth is just absolutely phenomenal, like far out. And Jack, we saw something like this. I remember 2 years ago, we saw someone that was solving the same problem space, but I wasn't expecting this type of traction this quickly from Marmalade, but well done.
The platform allows small and medium businesses to pay invoices on demand to alleviate cash flow challenges. So it's amazing that there can still be innovation and iteration around that invoice space. But last year posted a 65% increase in customer numbers and 100% uplift in payment volumes and revenues. Like that is a juggernaut. Yeah, raised 16 million, and that takes the total that it's raised to 32 million.
And it's a problem space that any business owner has felt, right? Like, how has this not been solved before? But yeah, well done, team.
The climate tech startup accelerator Energy Lab raised a record 289 million in 2023, which Australian-based startups accounting for 124 million of that total, despite a challenging year. That's a pretty impressive outcome.
It's phenomenal. Like, that is a great outcome. And 124
I haven't really heard about these guys before.
Neither.
Am I living under a rock?
No, they started in 2017, James Tilbury and Pierce Grove. But I hadn't heard of them up until this point.
Another reasonably large round was predictive intelligence marketing tech Profit raises $5 million seed round in a move resembling the transformation of the investment world in 1980 as funds hired quants in droves to take advantage of computer algorithms and advanced maths. Melbourne-based marketing tech startup has raised funds to make an impact in one of the most competitive and challenging markets of the modern era, the market for attention. So this is quite interesting. It's got some big backers from Anthony Catalano, Seek, co-founder Matt Rockham, and a number of others. So that was an article by Matt Ogg in Brisbane Business News.
Super interesting space. I think you see a lot of pitches targeting this space, and I always wonder how, because it's such a shifting landscape of consumer sentiment and also the algorithms changing and everything else, it'll be interesting how this plays out. But if they can crack that code, you can see the opportunity. My only thinking is, doesn't this eventually become a feature of someone else's product rather than a standalone business?
It'll be interesting to see. The article says, our testing to date has demonstrated profit can save businesses anywhere between 10 and 15% on marketing and ad spend by accurately demonstrating what's working and where budgets should be diverted for maximum impact. And that's going to dovetail nicely into our insert name of new episode deep dive type here on sales and marketing, because one of the things we're seeing is that generalist marketers inside companies don't work. You've really got to break it down, and you've got to have your media buyers or your media aspect that's then feeding to your content creators, who are then reacting to the data that's coming in what they should be creating in terms of content and how they should be changing that content. So it seems like these guys are helping at that front end of media buying to say, put money here, put money there.
Yeah, exactly.
This is your space, Jack.
Yeah, it's interesting because what was the EVP company that we spoke about a few weeks ago that was trying to crack attribution?
Let's get the name right this time. It's Mutinex, not Multinex. And what Mutinex seems to do is helping you understand that data.
Yeah, it's definitely a big problem for every company right now, is accurately tracking attribution. So yeah, interesting space. See how profit goes.
We discussed it at the VUTRAN event of Go One as well. So much money in an early stage growth business disappears out the door on social advertising, AdWords. Like, it's just such a big spend. So anything that can happen there to reduce that would be impressive.
Yeah, absolutely.
And then another reasonable size one, Perth-based telehealth medicine delivery company, Hola Health, has successfully closed a $4.5 million pre-Series A funding round led by Mate Ventures with follow-on capital from Fund WA and angel investors. So this is another good story, and Mate leading that. So that's great to see as well.
Yeah, great to see. Well done. It is interesting what's not on the list. Like we obviously, we completed a deal in that time too. I'm always curious about the ones that go under the radar.
Yeah, okay, but then we'd actually have to have a proper bloody PR function and actually tell people. You know, the journalists don't read minds.
Yes, that is true. But I'm just curious about the ones that aren't out there publicly.
They've got to talk to their shitty investors and say, why aren't you helping us getting some PR, you dickheads? But linked to that a little bit was a LinkedIn post that I saw from Sam Jacobs, who's the co-host of Top Line Podcast. And his post was talking about, in their experience, the best deals, as in the ones that actually lead to returns, are the ones that have almost no friction during negotiation and DD and whatever else. And the ones that have a lot of friction around valuation and negotiating terms and little words in contracts turn out to be the ones that turn to shit. What's our vibe on that?
Like, intuitively, it feels right. The only caveat I would add to that is 2021, there are a lot of deals that were done very quickly without any friction, but also probably in hindsight without a lot of DD and good thought that went into them. But
Sequoia putting $250 million into FTX kind of thing.
Yeah, exactly. And what we were seeing here in Australia with syndicated deal offerings just immediately closing before some people had even read the email.
I think it's one of those balancing things to me. I know I overly use these words, but when you feel like you're in just a good flow with people and there's good respect and you're building rapport and a relationship and you can deal with issues, that to me is probably the thing to balance on, not so much speed or ease.
Yeah, I think you're right. Look, it makes sense intuitively. I think so long as you're cognizant of the market cycle and whether all deals are just completing quickly out of FOMO, or you're actually in good conversation with the founders. There's no actual points of contention because things are being validated. The terms make sense. The valuation is solid. Yeah, the deal's going to complete faster.
Just looking back, like we've done 8 or 9 investments, like when the transaction goes smoothly, it's just better for both parties because at the end of the day, you just want the founder head down building, not stuck trying to raise capital. So like from our part, it's always better to try and agree on mutually beneficial terms so then they can just get back to building, and hopefully we're in the game to get the upside of a really good outcome, not to mitigate or protect our downside in a bad outcome.
And that's one of the joys of good co-investment with a party that you trust, that has brought a deal, that's done a whole lot of work already. When you can leverage the work of each other, that's when an ecosystem becomes really healthy.
And that's a good point. And that's something that we have a lot of luxury of enjoying is investor referrals, like really pre-qualified vetted deals where, like, I don't want to be arrogant, but there is some desire to have us on the cap table for the value add. So yeah, that's a really good point, Don.
Yeah, I think we're trying to live what we tell our founders, that niche, because then people understand who you are and you can become known for something. And as time goes on, people more and more are resonating with Tribe is the company to give a call and get involved. If it's a B2B tech-enabled company that has product market fit and is ready to go to the US or the UK. Now, that means there's a whole lot of great things out there that we're never going to invest in. If we can really concentrate on that, then it means we've got systems and process and experience and resources just to do that really well and then become known for it.
And while we're talking about things all going easy and swimmingly and they make for good deals, there was an interview with Jensen, the CEO and founder of NVIDIA, talking about how he wishes suffering upon people to make them better founders.
So it's only a short one. I might just play it quickly.
One of my great advantages is that I have very low expectations. And most of the Stanford graduates have very high expectations. You deserve to have high expectations because you came from a great school. You were very successful. You're top of your class. Obviously, you were able to pay for tuition. And then you're graduating from one of the finest institutions on the planet. You're surrounded by other kids that are just incredible. You naturally have very high expectations. People with very high expectations have very low resilience. And unfortunately, resilience matters in success. I don't know how to teach it to you except for I hope suffering happens to you. And I was fortunate that I grew up with my parents providing a condition for us to be successful on the one hand, but there were plenty of opportunities for setbacks and suffering. And to this day, I use the phrase pain and suffering inside our company with great glee. And the reason, boy, this is going to cause a lot of pain and suffering. And I mean that in a happy way, because you want to refine the character of your company. You want greatness out of them. And greatness is not intelligence. Greatness comes from character, and character is informed out of smart people. It's formed out of people who suffered. And so that's it. And so if I could wish upon you, I don't know how to do it. For all of you Stanford students, I wish upon you ample doses of pain and suffering.
Take that.
Oh, I love that, though.
We have a broad thesis that entrepreneurship is born out of trauma anyway, when you look at the behaviors and areas of focus and whatever else.
So that's even consistent with the cycles. Like when it's a hard time to raise funds, the really successful companies shine through it.
And what's the saying? Hard times make strong people make good times make weak people make hard times. But then hard times make strong people, and it's a cycle.
And even reflecting on Tribe's journey, like we haven't had it easy, but we're stronger than ever despite continuous setbacks, but things that we had expectations and then not meeting them, but we just keep finding a way and Tribe lives another day.
Totally. The resilient cockroach. And yeah, one of the things with his expectations, I think it's a threshold game. If you've got no expectations, you're probably in trouble. People that have incredibly high expectations, that just doesn't lead to functional anything. But then there's that sweet spot.
If you separate ambition with expectations, like you can still have the same level of ambition, but the expectation or the path of how you're going to get there can be different. Like it's not just going to be linear, and that's expectations are high, but he could be saying like, I have low expectations, but my ambition is the same level. And I know the path to get there may be really jagged. I'm going to die 9 times, but I'm going to keep getting back up. But at the end of the day, I'm still going to hit the same level of ambition.
You're right, Jack. You can have the ambition, but understanding that the path is likely to change. The how is going to smack you in the face at different points.
Yeah. Even just putting like our Tribe hat on, let's say we want to raise a fund, or last year it was very different, and our expectation was maybe one LP could come in and swallow that up. Our expectation has dropped so much, but our ambition is stronger than ever, and we're going to find a way regardless of how many LP it takes, but we're in it.
100%.
Absolutely.
That is a good distinction. And because I also think, to your point, Jack, about ambition versus expectation, one of the things we've been discussing in terms of what we want to commit to our LPs is that we can't guarantee the outcome, but we will guarantee a process and an approach and a certain set of values. And with that passion and expectation, as long as we've got the rails to run on and the process, and we're doing the right things in the right sequence, and we've got alignment, and we've got the foundations of trust and respect and behaviors and all of that.
And it's true on the founder side for us too, right? Talking about like just little change of our language, actually, Jack, that you led, which is spending time with the founders in terms of our ability to help and support them. We can do the process, we can spend the time with them. So the adding of value is where we make that commitment to be there, to go through, share our framework, share our perspectives. But ultimately, we can't guarantee the outcome for the founder either.
Yeah, agreed. Every time I try and forecast about how something's going to happen, it never happens the way that I predict. So like even anything in life, but it always ends up being a different path to what I thought it was going to happen, how it was going to happen. It's just funny how the world works.
Yeah. And then just being able to embrace that. But Jack, you've literally just unlocked the key to understanding life and happiness. Well done, young man.
Yeah. It's the Chinese horseman fable, right? Like it's so true. The things that you think might be a setback right now can ultimately actually be incredibly beneficial longer term.
Oh, totally.
And just on that point, I think that's why we back and have such an emphasis on the people and culture side of a startup. And like when we analyze a deal, like there's pillars that we look at, but like ultimately the only thing that's going to be there for the long term is the people and the culture. So we've got to have such high conviction that this team is going to continuously solve the day-to-day problems that come their way.
And shout out to Portfolio Co Gasbot in terms of the path that they have had and some of those moments of adversity where they've been truly tested. These could have been catastrophic failures. One of them was their manufacturing facility burnt down.
Their expectations got to be low now.
It's impressive to see and how they respond to challenges, and they've got that culture. It's part of their DNA. Is we will find a way.
Yeah, Phil, what was he? Messaged me on Monday. Do you have any inroads to this client? Oh no, sorry, I don't. But I'll have a look by Wednesday. No, don't worry about it. I found them, and we're doing a proof of concept with 400 devices, and then we're looking at this, and it's like.
Found a way.
So resilience is one of those big things. And another article out this week by John Buckley and Bronwen Clune of Capital Brief used the word resilience. Stone and Chalk touts resilience following $7 million loss and cost blowouts. The article says speculation about Stone and Chalk's future swirled in sections of Australia's close-knit startup sector this week amid a tough operating environment for co-working labs and a general decline in funding for startups. The difficulties faced by Stone and Chalk come amid a tough operating environment for co-working operators. Global industry giant WeWork filed for bankruptcy last year.
Can I be super petty and say they can't be doing it too tough, because it would have been sub $7 million loss if they let me pay for a year membership.
Yes. What's a year's membership?
Oh, that's just actually not that much.
$6,000.
Yeah, let's assume 6.
Okay, so what's $7 million less $6,000? But Jack, like ironic VC, incompetent VC. Let's start a new segment called Petty VC.
Petty VC.
Jack got rejected from Stone and Chalk when we said we want to be part of the ecosystem in Adelaide, and Jack's our analyst. He makes investment decisions. He's looking at a lot of deals. He can run workshops. He could help the companies there. They said no, which worked out again.
The expectations.
We've now ended up in an environment that is so awesome.
No, it's worked out. It's worked out good. It worked out perfect actually. And like just going back, putting away the pettiness, like I only wish the best for Stone and Chalk, and they are a component of the ecosystem.
Their financials highlight that this is a very difficult model if all you do is provide a desk. And why these ecosystems and these startup hubs actually need to have a lot more than a desk. Otherwise, you're in the shitty business of taking long-term leases to a landlord and selling short-term leases to credit risks.
100%.
You might know something about this.
Yeah, so my little foray into a startup hub with Silicon Lakes, which was running as a not-for-profit, and we had space, like essentially gifted to us by the City of Gold Coast Council, and we still could not make it financially viable. But globally, this is true. The only models there's only so many models in this startup hub space that work, and they all serve some other primary purpose outside of the co-working space. The co-working is a bolt-on. And I think of Galvanize, which is incredibly profitable. They run co-working hubs, they look like a co-working hub and space for startups, but it's really a finishing school for tech engineers to go and get qualified to get a job in a startup. And they're pulling something like 8 mil a quarter in profits out of that training side. And then the startups in the space become basically projects for those students to learn off. And so that's one model. Then VCs that run co-working spaces, but that's more of a deal flow play or subsidized play.
But have a look at Space.
Yeah, Space Cube. Now, what Brody has pulled off is phenomenal.
And what have they done?
Yeah.
They've gone niche.
Right,
for a particular sector. They've got value adds around it. They're going to like weird and wonderful environments to attract those customers. They're creating this innovation environment.
And they've also partnered with their commercial property partners. So they end up activating commercial space in those buildings. They add value to the property portfolio itself. So really, Brody probably in Australia is the leader at making this model work as a profitable venture. And then there's Core. So Core is the mining hub specific, and then Space Cubed is the more generic one.
Yeah, great. Good shout out to them. And keeping on the theme of resilience, Elaine Stead was great to see. It was announced that she has joined Main Sequence.
Yeah, fantastic news. Like absolutely amazing for Main Sequence to have someone like Elaine with her expertise, and absolutely stoked to see that announcement yesterday.
We're grateful for working with Elaine to get Tribe up and running. This podcast was started there. Definitely missed the good times, but just great that been part of the journey. That I think it's a really great place at Main Sequence. It's Dr. Elaine Stead, and the doctor is because of the health and tech and that work that she had previously done. And in terms of Main Sequence being such a deep tech investor that has all the funds under management, that's got a brand, I think she's going to be
really good people too. Like all the Main Sequence people are just absolute legends, like just good, solid humans.
Someone else that came under was Richard White of WiseTech. And there's an article out by Yolanda Redrup talking about how this billionaire is making his staff rich. Staff members collectively sit on more than $320 million worth of shares at WiseTech. Of its 3,300 employees, 85% actually own shares thanks to their share scheme. A lucky few who started at WiseTech before 2005 have seen their shares go from 7 cents to $97.
Wow.
One of the early employees, Chief Technology Officer, Brett Shearer, he joined in 1994 and owns about $32 million worth of shares. Mr. White said, all I do every day is turn up with a growth mindset, make the business better, and give something back to people who work for us.
Great line. Makes it sound so easy, but far out. Well done.
He was using ESOPs before ESOPs were cool. Like, clearly he's used this as a great tool.
That is absolutely phenomenal. And it's great. This is what really excites me at the moment. Like, we talk a lot about secondaries, the increasing use of ESOP. This recycling effect, like this ripple effect of particularly early employees that took the risk. We talk about founder risk, but for an early employee, like for Jack to join us and to start as an intern, unpaid, and then by definition, still unpaid by some measures, it's a huge risk. But for that to actually play out and end up in this ripple effect where now there'll be a recycling of that capital too. And we saw this with Facebook. When Facebook IPO'd, the first 1,000 employees became millionaires. And then they often ultimately go out and start their own startup or become active investors in the ecosystem. So this is the multiplier that we've been waiting for as the catalyst to really enhance the ecosystem now.
Any thoughts your end, Jack?
No thoughts. What is the story about was it the cleaner at Facebook that got on the ESOP and became a millionaire? Apparently it's not true, but it's a funny story.
Oh, it's a good story.
Yeah.
I hadn't heard about the cleaner. I heard about some artwork.
Yeah, was it the cleaner or the chef? One of them, like the kitchen hand, had access to an ESOP. But yeah, don't let the facts get in the way of a good story.
Plug and Play, so talking about incubators and hubs that don't make money, Plug and Play, which was a co-working space with a program, gave desks originally to the founders of eBay because they couldn't afford the rent or anything, so they took some equity, and apparently that paid out like something, I think it was the order of magnitude of hundreds of millions it ended up making the Plug and Play. It's just phenomenal. Maybe that's a model for Stone and Chalk, just ditch the rent and take equity and back good founders.
One of the other things I saw this week was a post by Carter where startup headcount growth spluttered in 2023. So for those listening at home, the chart goes back to 2019, reasonably stable, like 10,000 to 20,000, 10,000, 20,000. Then COVID hits and it has this little negative pitch. And then as we know, after COVID, holy moly, it just ramps through. So it hit 51,000, keeping in mind the average is like 15,000, but it just grew 20, 30, 40, 50. But then it obviously died, as we know, with the markets, but now it is trending literally downwards, where we've now had the biggest drop in startup, according to Carter, was like 10,000 for the month. It was 7,000 last month, 3,000 the month before. And so in a world where startups are contracting, we're having to become more resourceful rather than resources. We don't have as much money to just pay people cash. I think we'll find ESOPs and equity to find and attract the best talent that when you can't afford to just be writing out big checks, I think is going to be a continued theme. And a shout out to Cake, who's one of our portfolio companies, Cake Equity. They make that whole ESOP and equity process just so easy with a few clicks.
Yeah, absolutely. For founders, definitely check out Cake, just simplifying that whole process. But that drop in talent, that is phenomenal. That's fairly consistent over like the 23 data, just consistently negative growth and then also accelerating.
Yeah, it's accelerating, right? A rate of change is absolutely accelerating, and a body in motion tends to stay in motion. So I'm going to be very interested to see how the next quarter of the data set plays out, one to watch. But someone that's accelerating on the other side, so let's move into our macro and public market charts. So these are just my random charts from during the week. These are little theme music, like da-da-da-da-da-da.
Jingle.
I've, of course, managed to just delete the show notes from my computer. What a genius.
We need something equivalent to the Harry Stebbings, "You Have Arrived," when the podcast starts after the advertorial piece.
And then the gong at the end of the show. Have you noticed that? Like it's almost in The Office, Jim trains Dwight that every time there's a noise to ask for a mint. That's the way. So yes, NVIDIA's been good. Since the beginning of 2023, it's up 425%. But super microcomputer is up over 1,200%. So this chart here just shows, and we're only in March of 24, so this is what, 15 months? It is just this exponential curve.
Yeah, listeners that can't see the chart, it's basically from 24, super microcomputer just went vertical from circa, what would that be, 250, 300% growth to 1,200.
Yeah,
that's phenomenal.
Just amazing. But they're riding AI. And so here's a chart of the number of S&P companies citing AI in their earnings calls over the last 10 years, broken up into quarters. As you can imagine, very few back in 14 and 15. Interestingly, there were some early people in 16 and 17, but then it's like reasonably flat. And now it just seems everyone is talking AI in their earning calls. And I see some companies just changing their email and website to .ai. And if that doesn't make you an AI company, I don't know what does.
And this is consistent with pitch decks. If we could cite the number of AI on pitch decks, it'd be a very similar trend.
Yeah. Now, another data set that came out, this is from Bank of America, more with less, workers needed at S&P 500 companies to generate 1 million in revenue. Well, that's amazing, right? It has just gone from 8
productivity
down to 2.
Which shows the power of technology and the ability to leverage it and channels to market. And I assume it's probably CPI adjusted, but even if it's not, look at that transition, far out.
But unemployment is still quite low broadly. So again, tech has able to come in and create efficiency, but we haven't seen mass unemployment. So it's going to be interesting to see if AI can do the same thing. Now, we've been talking quite a bit about interest rates, and even in the last few weeks, I'm seeing a lot of stuff of people coming around to the idea that interest rates aren't going to get cut. And so from January 24, this is the implicit number of cuts the Fed's going to make in 2024. And the prediction was like close to 7. Now it's shrunk to 3. Like it's shrunk to 3 in 3 months. Now, keep in mind, our Federal Reserve, our Reserve Bank, these are like masters of the universe. They're central bankers. They know what's going on. Don't forget, they told us that they weren't ever going to increase an interest rate until 2024.
Yeah.
And we had how many in a row? And we're sitting at whatever level. And so now suddenly people are starting to walk that back. And this is out of the US. The 2-year yield is actually really quite good at tracking and forecasting which way short-term rates are going to go. And if you have a look at that black line, so for people at home, the black line, the 2-year yield was like at 4.1%, which was implying a certain number of cuts. But in the last 3 months, that has crept up to nearly 4.8%. Now, that is fairly significant. And what's on there is the China FXI index and also the price of copper, because those two things often are precursors to boom and bust in the world economy, and they're all tracking up as well. And so we've just got to be a little bit careful of saying that interest rates are going to fall heavily. So those are just a few charts. Now, remember, as I say, I think tracking this stuff is around curiosity and seeing trends and interesting data sets, but never bet the farm on it and never change strategy holus bolus. But sometimes it's adjusting at the margins. And so if you're moving into an environment that you need interest rates to drop in the next few months to be successful, there's some data there that's saying, hey, maybe have a look at some of those assumptions. But don't take it as black and white. These are just some, like I couldn't even get names of companies earlier in this podcast right.
Insert our standard financial disclaimer at this point.
Correct. So that brings us to the end. What are we looking forward to?
I am no longer facilitating the Startup Weekend Sunshine Coast this weekend because of some illness amongst the organisers. But tomorrow I head to Townsville to deliver a session on investment readiness for the hub up there. So that should be interesting. And then I've got some one-on-ones with founders. So really looking forward to that tomorrow.
And don't forget the weekend.
Yes, although I did just get a message for his founder substitute. So,
Jack?
my bad.
I'm playing a trial match on Saturday, and then Sunday will probably just be low-key, quiet weekend.
Trial match. Yeah. Enjoy it, buddy.
Are you the captain?
No, it's a trial match, Don.
Hang on.
Yeah, but that didn't answer the question.
How do you still, even a trial match has a captain?
No, but I haven't picked teams, so you can't. You got to make the team first before you call the captain. So there's no.
How do you have a match without a team? Who are you playing? Are you just running around or like
trial match? Internal trial match.
Ah.
Yeah, the season starts first week of April. It's just a internal trial, and then up top for a couple of beers with the boys.
Just your training is exhausting me. You haven't even got to the start of the season.
Yeah, I know, yeah.
I'm loading the family up into the caravan, going down to Pottsville. I've got a shout out to Terry and Bernie to see if they're going to be down there.
Awesome.
Now, the last time we went to this caravan park, I left my newborn in a pram and walked off. I have high hopes for better performance this time.
Maybe the less said, the better. Wasn't this the same place where you cut your leg open on the oysters on the pier?
Yeah, taking my 3-year-old to jump off a bridge with me.
Yeah.
That one.
that one.
Yeah.
Is it good weather at the moment?
Yeah, no, I'm hoping it's going to be good. So we drive down, I get him set up, then I drive to the Brisbane Angels event that Aaron was supposed to be speaking at, but I'll have lunch there, then I'll get back down.
That'll be fun. That'll be good.
Yeah, so I'm looking forward to it. All right, catch you on the other side.
All right, see you, boys.
There you guys.